tensions are flaring yet again between the US and Iran, and oil prices are firmly on the rise once more. But beyond the Brent crude rally, it is the safety net underneath the oil market that is now coming under serious stress. Every time hostilities have resumed during this conflict, our first instinct has been to check the reaction of oil prices. And sure, no one doubts the importance that price spikes have for inflation expectations, central banks, consumers, businesses, and governments. But price alone does not tell us much about the underlying resilience of the global oil system. That resilience is now being severely tested. The International Energy Agency describes the current oil supply disruption as the largest in market history, with cumulative supply losses from the region already exceeding 1.3 billion barrels. In response, the oil market is now leaning heavily on its emergency buffers. So far, those buffers have helped prevent a much worse crisis from unfolding. But they also have limits. And if new disruptions keep arriving before the system has rebuilt its safety net, the next shock could deplete those buffers to critical levels. So the crucial question we should be asking is, just how much shock-absorbing capacity does the global oil system still have left? Because oil markets do not break only when supply disappears. They break when the buffers that absorb disruption begin to run low. The Gulf sits at the very center of the global energy system. When conflict escalates there, traders don't wait for oil to physically disappear before they react. Instead, they immediately assess the possibility of disruption. This is why oil reacts so quickly to Gulf headlines. The market is not only pricing what has already happened, it is pricing what could happen next. But we need to separate the price from the resilience of the underlying oil market. The oil price tells us important conditions about the market, including current supply and demand, future expectations, geopolitical risk, investor positioning, OPEC decisions, and dozens of other factors, all compressed into a single value. But the price does not tell us which buffers are currently absorbing pressure, or who controls them, or how quickly they can be replenished. The price also does not tell us whether the resilience of the market is being broadly distributed or concentrated in the hands of a few powerful states and producers. So our argument is that price alone does not tell us much about the relative strength of the safety net underneath the market. And if that safety net is thinner or becoming more concentrated or harder to replenish than the headline price suggests, then markets may still be underpricing the system's vulnerability when the next disruption hits the market. So what exactly do I mean by oil's safety net? It is a stack of different buffers that exist to prevent an oil market disruption from turning into a much wider economic crisis. The first buffer is inventory, such as commercial stocks held by refiners and traders, as well as the strategic reserves controlled by governments. The IEA says inventories were being depleted rapidly, while member states authorized their largest ever collective release of emergency oil stocks. So part of the resilience in the market came from drawing down oil inventories that had already been produced or stored and held back precisely for this kind of emergency. The second buffer is the ability to redirect supply. Some Gulf producers have pipelines and export terminals that allow at least part of their exported oil to bypass the Strait of Hormuz. Saudi Arabia can move crude west to the Red Sea through its east-west pipeline, while the UAE can export through Fujairah on the Gulf of Oman. These routes can't fully replace Hormuz, but they give Saudi and the UAE options that other exporters do not have. The IEA estimates that higher output from the Americas, combined with releases from the US Strategic Petroleum Reserve, increased Atlantic Basin crude exports to markets east of Suez by around 3.5 million barrels per day. So logistics, infrastructure, and geography are also part of the safety net. The third buffer is spare production capacity. This is oil that a producer is not pumping today, but could potentially bring to market during a disruption. Usable spare capacity requires working wells, processing plants, and export routes, as well as a producer that's willing to release the barrels. Saudi Arabia is the clearest example. It has historically controlled the largest share of the world's spare oil capacity. But when attacks on its Abqaiq and Khurais facilities in 2019 briefly disrupted around 5.7 million barrels per day of production capacity, they exposed the crucial weakness that oil capacity cannot cushion the market if the infrastructure needed to process and export it is impaired. So the real question is how much capacity can be brought online quickly, delivered to buyers, and made politically available. The fourth buffer is weaker oil demand. The IEA now expects global oil demand in the second quarter of this year to be almost 5 million barrels per day lower than a year earlier. During an energy shock, demand can fall because fuel has become too expensive. For example, a factory reducing output because transport costs have surged helps lower oil demand. But that is economic damage, not healthy resilience. The fifth buffer is the global refining system, which the IEA says has made rapid adjustments to offset losses of both Middle Eastern crude and refined product exports. Each buffer buys the system time, but each buffer also has a limit. Now put the scale of those adjustments together. Cumulative Middle Eastern oil supply losses have exceeded 1.3 billion barrels. And even after supply began to recover in June, global oil production was still around 9.4 million barrels per day, below its pre-war level. The US government estimates that global inventories were depleted at an average rate of 5.1 million barrels per day during the second quarter, and expects them to fall by another 2.2 million barrels per day during the third quarter. Meanwhile, global refinery runs remained 6 million barrels per day lower than a year earlier. This is what serious system stress looks like. Inventories, emergency reserves, alternative exporters, shipping networks, and refiners all being forced to compensate at the same time and at an exceptional scale. The system is now beginning to recover, but it has not yet fully repaired the damage created by the previous disruption. So the crucial question is how much of the safety net is already being used? How quickly can it be rebuilt? And who still controls the remaining options? Because buffers are not just technical features of the market, they're also a form of power, because the actor with the most options can withstand pressure for longer. It can delay difficult choices while weaker actors are forced to adjust immediately. And this is where the balance of power becomes uneven. A major importing power, such as China, may have strategic stocks and the fiscal room to protect consumers, but a smaller importer, such as Sri Lanka, may have none of those advantages. Sri Lanka's 2022 crisis showed how a country can suffer long fuel queues, power cuts, and severe shortages even when the world has enough oil, because it lacks the foreign exchange and financial capacity to buy it. The Sri Lankan government may have to choose between subsidizing fuel, cutting other spending, or passing higher costs onto households. So when a shock hits, the winners are often not simply those with the most oil, but those with the most optionality. Then there are oil transportation issues to consider. The US Energy Information Administration reported that physical danger to vessels, combined with the cost of war risk insurance, pushed tanker rates from the Middle East Gulf to record highs during the crisis. And those additional costs spill out beyond the shipping industry. They become part of the delivered price of energy. For a South Korean refiner, for example, imported oil may still arrive, but at a higher landed cost before a single barrel is even processed. The Lloyd's Market Association said marine war cover remained available during the disruption, but it also said that safety concerns were driving the reduction in vessel traffic. So the shipping buffer only works if vessels, crews, insurers, banks, and ports can all operate. This is why an oil shock is also a financial shock. Risk moves first from the battlefield into insurance premiums, then from insurance premiums into freight rates, and from freight rates into delivered energy costs, and eventually from energy costs into inflation, company margins, and household budgets. So what exactly might markets be underpricing? We need to be careful here. Oil traders are monitoring buffer levels, including inventories, spare capacity, and shipping risk. And those expectations are already at least partly reflected in prices. Instead, markets may be underestimating the system's fragility. The first disruption may be absorbed fairly smoothly. The second disruption may require a larger release of reserves. The third may arrive when alternative export routes are already congested, inventories are lower, and governments are less willing to intervene. At that point, a disruption of the same physical size can have a much larger impact. Potential market mispricing, therefore, becomes about the value of tomorrow's remaining options. And those options may deserve a larger premium when they are concentrated in the hands of only a few governments and producers. Markets may be placing too little weight on the political and logistic conditions, determining whether the remaining barrels can actually reach buyers. There is a credible recovery path. The EIA expects most Middle Eastern production and trade flows to return to pre-conflict levels by the end of the year. And the IEA reported that observed global inventories increased in June for the first time in 4 months. But that recovery remains conditional. It depends on tanker traffic through Hormuz continuing to normalize. It also depends on Gulf production and refineries restarting. And it depends on governments and companies being able to rebuild the stocks they have already used. Collapse is not inevitable. The immediate danger is that renewed disruption arrives while the system is still repairing the damage caused by the previous shock. So how do we judge whether the safety net is being rebuilt or becoming even thinner? There are several indicators worth watching. The first is global oil inventories. If commercial stocks begin to recover, the system regains part of its cushion. But if they continue falling, every additional disruption becomes harder to absorb. The second indicator to monitor is the tanker traffic through the Strait of Hormuz. If vessels remain hesitant despite official assurances, it tells us that the practical risk of traveling through the strait remains high. Third, freight rates and war risk insurance. These can reveal stress before the full effect becomes visible in headline oil prices. If freight and insurance costs remain elevated, the market may still be playing heavily to keep supply moving. And if energy pressure persists, watch the central banks, because the shock can eventually reach households through interest rates as well as fuel prices. That matters for ordinary people, because once an oil shock influences interest rate decisions, its effects spread far beyond petrol prices. Oil's safety net has prevented a severe disruption from becoming even worse, but that resilience has come at a cost. Stocks are drawn down, and households are forced to react to absorb higher prices. So when oil markets appear to cope with a shock, we should not assume that the pressure has disappeared. Often, it has simply been transferred from producers to reserves, from shipping routes to alternative infrastructure, from companies to consumers, and from current prices to future vulnerability. So the key question is, how much room does the global oil system still have to absorb another disruption? Because the next oil shock does not necessarily need to be larger. It only needs to arrive when inventories are lower, routes are tighter, governments are more reluctant to intervene, and ordinary people have less capacity to absorb another increase in costs. That is when a manageable shock becomes a crisis. If you found this analysis useful, consider hitting the like button and subscribing to the channel. Here at Markets and Power, we examine how states, institutions, and corporations exercise power, and how markets, capital flows, and economic outcomes reveal the consequences of those choices. Thanks for watching, and I'll see you in the next video.